My name is John Hogan, and I'd like to tell you about a tool you should be interested in if you are interested in determining the likelihood of meeting your financial goals. Let's get right into the tool at first before we get into the back of what composes the tool. The user with this tool inputs what they believe about the equity market, both return and standard deviation, what they believe about their fixed income market, again, return and standard deviation, whether these markets are correlated with a correlation coefficient between -1 and 1. You really have to be familiar with these terms if you want to use this tool, and you should be familiar with these terms if you have any significant amount of money that you are investing and trying to make sure that it grows. You have a wealth goal. In this case, we're doing a college scenario, so the wealth goal for one child might be $200,000, saving $7,000 a year, starting with $50,000, 10-year horizon. This is the allocation between equities and fixed income. You put that in, and immediately the tool provides the probability of wealth for that investment strategy. Probability, what the actual wealth is, here your goal is, and the tool also says what the probability of meeting that goal is, and then the 75, 50, 25% points that come right off this chart. So with this information, you can start saving sooner. If you don't like that probability of 50%, you can save more. You can look at less expensive colleges, whatever, but you now have information based on the actual probability of you reaching the goal that you set for yourself. If you had looked at a retirement scenario, again, we put in the information about the markets. Here we have a goal of $1 million, annual savings of 5,000, starting with 200,000, 20-year horizon. There's a 46% probability that the goal will not be met, which is not very comforting. Here are the numbers at 75, 50, and 25. So there's some probability that you'll really be extremely lucky, but it's a fairly low probability. More likely, you'll be near the range of 50%. And if that's not satisfactory, you might want to increase the savings. And if you increase the savings to $10,000 a year, immediately your probability has now 71%. 29% probability that it will not be met, 71% probability that you will meet your goal. And the calculator tool also works for withdrawals. So here with withdrawing money over a 20-year period, minus $40,000 a year from $1 million, we want to end up with $500,000. And again, the model immediately tells you that there's only a 9% chance your goal will not be met, a 91% probability that it will, and here are the numbers again at 75, 50, and 25%. Now, what is this model based on? It's not based on Monte Carlo. Okay, it's a closed form solution. What it's based on is the mathematics of Brownian motion applied to stock prices, the properties of log normal distributions, a lot of matrix mathematics from modern portfolio theory, and the functionality of Excel. It's not based on Monte Carlo, but here's a comparison of the closed form solution to Monte Carlo for the growth of a nest egg. Here's a comparison for annual contributions to a portfolio between the closed form solution and Monte Carlo. Again, excellent correlation, a lot more noise in the Monte Carlo solution, as you might expect. The closed form solution, a straight or a continuous probability distribution as shown in the figure. And it also compares very favorably with historical data. Here are 20-year periods from 1920 to 2018, and here's the closed form solution. And there are 78 such periods, 20-year periods between those two endpoints, and you can see very good correlation with the trend and the actual numbers between the closed form solution and historical data. There's only 78 such periods, so there's more dispersion than there was when we looked at 1,000 points with the Monte Carlo solution, but again, the trends and the actual values are very well correlated between the closed form solution and historical data. So we all know the nostrum: those who understand compound interest collect it, those who do not pay it. To this we can add Those who understand compounding under uncertainty, which is what this tool is all about, can plan for a future consistent with their risk tolerance, and those who do not may be in for an unpleasant surprise. There's my contact information, and you can find this tool at this URL, spreadsheetnut.com, but if you type that URL in, it will take you to the tool that I've been using in this presentation. Thank you for listening.